Hey guys, how you doing? This is Glenn Griffiths of the Griffiths Insurance and Financial Services. So I wanted to chat with you guys today about actual returns versus average returns. We hear a lot with investments about average returns. My funds have averaged this over the last X amount number of years. My funds have averaged that. But it can be a little bit deceiving if we operate in that way. Because at the end of the day, what do we spend? Do we spend averages or do we spend actual dollars? We spend actual dollars. So I put together a little bit of a presentation. I'm going to share my screen and I'm going to show you guys what I'm talking about. Okay. All right. So we're looking at, put this in slideshow mode. Okay. All right. So hopefully you guys can see my screen here. So the difference between average and actual. So let's start with this. Let's say we want you to adjust your thinking on money. Okay, so let's roll with me here. You have an asset that you bought. You've got a set payment in this case for 20 years. You build equity every single year and the value can never ever drop. Regardless of your employment and your credit situation, you can access up to 90% of your equity and the process takes 1 to 2 weeks. Now, let me repeat that. Regardless of your employment and credit situation, you can access up to 90% of your equity, and the process takes up to a couple of weeks. So here's another one. You lose your job in 2 years and you can't make payments for 6 months. You don't lose your asset. Contractually, your equity is used to make your payments. So I know at the beginning, quite a few of you might have been thinking this was a house, but if you've ever owned a house before, you realize that in this statement, it probably isn't the case, right? Because if you do lose your job 2 years into your mortgage and you can't make payments for 6 months, you've got some issues. That thing is generally going bye-bye. Well, let's skip on. You can catch up on the payments at any time or tack it on in the end. That is huge. At any time. You can pay any amount, set or ad hoc, to catch up on the payments. So you don't have to be locked into a payment. Flexibility is key with this. Oh, and you know what? Those funds are available again as soon as you make the payment, kind of like a revolving line of credit. It's not a house, as we said earlier. It's life insurance. It's specifically designed life insurance to maximize cash values. So in this case, it is a lifetime asset and not just there for your debt. Let me say that again. It becomes a lifetime asset and not just there for your debt. So you have more control over costs because the typical stuff like maybe maintenance, property tax, replacements of this or that, and house insurance don't apply. Falling stock markets or falling markets, whether that's the stock market, housing market, or recessions, and we're in a little bit of all three right now, cannot reduce your value. Let me repeat that. Falling markets cannot reduce your value. You control the asset, so you dictate access and the payment schedule. Does that sound like something that could make sense in your life? Having some more control. And really, in essence, you become your own banker. And that is what the whole IBC, infinite banking concept that was founded by R. Nelson Nash, is all about. It's using your insurance, building up that asset, and then accessing it at your own terms. And that makes you, in essence, your own banker. So, you know what? We can talk and talk, but I'm going to use a couple of examples. I'm going to use a set of twins. This would be Bob and Bart. They're both lawyers, both earning $200,000 a year, right? They work at the same firm, and they decided they want to put away 25 grand a year each. They've come to see me to find out what I would suggest based on what their goals are. Now, I spoke to both of them. Bob decided to roll with me. So we set up a policy with the intent of making it an IBC type use policy. And Bart looked at me and said, man, you're smoking something. I'm not putting any money in insurance. You're crazy, and I'm going the traditional route. So he goes and invests in RSPs because he wants that refund. And you know what? He's putting money away. At the end of the day, it's a positive, putting some money away. but we'll go on and see where it may not be the most efficient way for him to go. So here's the thing, third line down, first year value to his family. Now, we're not trying to kill the twins off, but life does happen. So in the event that they passed away within the end of the first year, we're looking at about 27,500. And line 5 kind of tells you why it's at that. So they put 25 in. We have a 5-year averaging 10%. We're going to just assume that it's a smooth 10% each year. Not likely to happen, but let's just do that for this example's sake. Right? So 27.5 per year, which if that rolls to Bart's wife, is non-taxable rolling to her. But if she goes to access it, it becomes taxable. If it's his kids or anyone else, it's taxable right away. Okay, so he doesn't really leave 27.5 in usable dollars. Okay, now let's look on the other side. Bob's first year value to his family is 564,500, tax-free, I might add. Huge difference right off the bat. Now, it's interesting in the next line when we talk about 5 years in actual dividend, we'll say the dividend on this actually does about 5% a year. So that's a steady, boring climb, just climbing the stairs 5% a year. But over on this side, we talked about Bart averaging 10% a year. It seems like Bart's a smart man for avoiding me and thinking that, you know, I'm crazy, I don't know what I'm talking about, and he can make much more. So far, so good. Let's look at what we're looking at for fund values. The next line, Bart's got about $208,153 in his RSP. Bart's feeling pretty good. Keeps telling his brother, Bob, you got to ditch that guy and come to my guy, because your guy is just an idiot. He doesn't know what he's talking about. You could have been way ahead, but instead you put money in insurance. Now, Bob and I communicate frequently, and he's got a plan. He's going to keep on working that plan. So he says to Bart, you know what, bro, I'm good. I'll continue. So he has $115,000 of accessible cash. All right, year 6 rolls around. What happens? Like we've seen the first 6 months of 2022, market drop. In this case, market drops 25%. All of a sudden, Bart's 208 is now 156. We've got a little bit of a recession going, works a little slow, and some stuff starting to break. Just how things go sometimes. Here's the key. He needs 50 grand cash yesterday to cover some necessary repairs. All right, now he had 156,000 because he had a 25% drop on his 208,000, and that's where it landed at. So to get 50 grand cash in his hand, now here's the key. He needs to withdraw $71,000 right away to get 50 in his hands, because there is going to be a withholding tax. And that's how much the institution holds on to, shifts to the government to offset your taxation. But it's not done there. Why not? Because the RRSP is a tool that says when money comes out, it is classified as taxable income. So that whole 71, we'll say, gets added to about the 200,000 for income, and that year's income tax has $271,000 of income that's taxable. Meaning Bart's gonna owe roughly another $12,000 in taxes. So think about this. To get 50 in his hands, he took a $83,000 hit. 83, huge. So let's see what's happening to Bob on the other side, because Bart's all stressed. He goes to Bob's house and he's like, man, bro, I got to cash out some money of my RSPs. I'm just getting murdered in taxes. This sucks right now. And then he looks at Bob and he says, Bob, why are you so calm? And he said, you know that insurance plan I've been working? Well, I see some opportunities now because the market is lower. There's a bit of a recession. So I see where that becomes favorable, because I decided from the get-go to be a bit of a contrarian and wait for opportunities to come my way. What do you mean, Bart says? Bob says, well, I'm going to borrow $100,000 out of that cash value that I have accessible. And when I say out of, let me qualify that. I'm going to borrow against that cash value. So we're going to have the cash value as a levered instrument, and we're going to borrow $100,000 from the insurance company. Why is that important? Because we're not interrupting the actual policy growth. It continues to grow doing this boring old 5%, but it continues to grow. So what does Bob do with his 100,000? Bob sees that stocks are dropped. So he looks for some good quality stocks and he says, you know what, these are at a discount. I'm going to spend 25 grand and buy some stocks. Now they're talking about their friend Rob. Rob got laid off. Rob has a home and a mortgage, and Rob is short of money. He is bleeding cash. He went to one of those places that he got a loan for 36%. It happens, look it up. And he's stressed because he's worried about servicing that loan, paying his regular mortgage while hunting for a place to get another job. He's talking to Bob, and Bob says, if I could get someone to give you a loan at 15%, would you consider that? Rob says, are you joking? To get from under this 35% loan? I would gladly do that. So guess what Bob does? Bob says, you know what? I'm going to become your loan officer. I'm going to loan you that 25,000. And of course, to protect myself, I'm going to write it up, put a lien against your property, just like anyone else would, to make sure I'm protected if anything happens to you or if this goes sideways. So he loans him 25 grand at 15%. Now it's important to let you know that this loan that Bob accessed was at 5%. So now he's loaning out 25 grand at 15 to help his friend. Is his friend happy? He went from 35% to 15. He's ecstatic. Is Bob happy? Bob's found a way to deploy his capital to make money and bring back some friends. Now, what does he do with the other 50? Well, they have a favorite place that they go, right? And this company, great company, continues to make money, but things are a little tight. Things slow down just a bit. Not enough to really cripple the company, but they had some equipment breakage happen at the worst possible time. And the owner is just cash strapped. Can't get equity from his house because housing prices fell, doesn't have any more room, used up his line of credit, it's just tight. So he's talking to Bob, and Bob says, you know what? What do you need? What's going on? What would help you? And he said, man, I never wanted to do this, but I want to be able to maintain control of my business because I've been running it for a while and I know exactly what it needs. We're in a good spot. We just got to ride this out, but I need this equipment in order to operate. If I could just get somebody to loan me some money or even buy into my business that doesn't want to become, pesky and tell me how to run it, life would be awesome. So Bob thinks, what if we get this contract written up? I buy in as an equity partner with 50 grand, get a percentage of your business. You do the running. I have no interest in that. I'm just going to be an equity partner, right? And get taken care of as such. The guy is ecstatic. Now he gets to buy the equipment and also has a little bit of cash flow in reserve. And Bob's now part owner of a thriving business. So let's look at this again. We had Bart, who averaged 10% a year until we had the drop. We had Bob, who only did 5% actual per year. And then when money was needed, that's the second part of this, not just the average versus the actual, but where do you have it? Where is your equity located? Bob's is accessible at 5%. Bart cost him over 40% because of the tool it was in. He had to pay so much taxes to get to it. So let's continue. So Bart's tax bracket creep is now about 47%. 50 grand cost him 83,000, and it did so at the worst possible time because he needed it during a recession when markets were low and his funds were low. Will he get that 83 back again? If the remaining 70 plus thousand even goes up by 50%, understand that he's not even going to be at 100 grand. He's not going to be at half of where he was before because he has permanently lost those funds by withdrawing them. Now, on the other side, we've got Bob. Okay, Bob accessed 100,000 via a loan against his policy, collateral. He's got 5,000 in interest, which is covered by that second mortgage that he loaned to Rob. Now, he's still only actually making 5% a year, but that thing just keeps on growing, And there's more cash to access each year. So let's stop for a second. Did the 10% average up to this point work out better for Bart? How is it compared to the 5% actual for Bob? Actual money, and then in a better vehicle where taxation is not an issue, where cost to access is so much smaller, 5% versus over 40%. So there's a few things at play here what we don't normally consider. So let's move on a little bit. Let's look at estate value. Estate value at this time for Bart, 85,000 taxable. Let's hope nothing happens to him, but that's what it is. The estate value for Bob has gone up from 564,000 to 1.4 million. So if Bob were to pass away, his family gets 1.4 million tax-free. Bart's family gets 85,000 taxable, right? And it would roll to a spouse without taxes, but to actually use it, there would be taxation. So let's run it to age 60, because it's 20 years later, and we find out that, now guys, let me pause here for a second and interrupt. We're still gonna run with this notion that Bart continually averages 10%. Well, we're gonna say in fairy tale land that he never has another negative year between this age and age 60. We know that's not gonna happen, but let's just say, because I wanna show you how drastic these differences are. So no negative years, continual growth, 10%, put in 25 grand in a year. Age 60, his value is 1.22 million. Pretty good, right? Well, it is, but we know 10% without any negative years is not going to happen. Nonetheless, for this example, let's continue to play along. So 1.22 million taxable, right? And that's 10% with no down years. Let's look at Bob. Now at age 60, Bob has accessible cash value. He's got cash value of 748,000. What's his estate value if he passes? 1.68 million tax-free. So we've got 1.22 million taxable, okay, in which case we're looking at roughly about 750,000 after taxes, or we've got more than double that, 1.68 million tax-free over on Bob's side. Now, Bart averaged 10%. Bob had an actual 5% growth, but because this is cash, there are no negative years, so it continually grows. Yes, much more boring, but so much more predictable. And then the access to that cash all along the way, regardless of his circumstances, we can't even quantify that, because how many other times was Bob able to go in and use that cash? We don't even talk about that part of it, right? Because he can borrow against his policy that is never interrupted, that keeps on growing for a multitude of opportunities when they come his way. So again, 1.68 million tax-free, 1.22 million, so probably about $750,000 after taxes, more than double available to family. And what was the out-of-pocket cost? It was the same thing, 25,000 a year for that 20-year period. So I know I've given you guys a lot to think about there. What would I like you to know? Well, this process that Bob used is called the infinite banking concept. I'm one of less than 50 authorized practitioners across Canada at this time, midway through 2022. But here's the big key. You don't have to die to benefit. You can use this for your whole life, and that is a pun and a deliberate play on words. You can use this for your whole life. Buying earlier compounds much faster. Think of a snowball downhill. You have unlimited times to access cash values. As long as there's cash available, you have access. It is that simple. Here's the huge key that we forget. Forget the actual 5%, well, I wouldn't say forget, but along with the actual 5%, and then looking at the average 10%, and we saw how those numbers don't really mean anything in the long run if you can't have access when you need to. Here's the biggest thing you should recall. Taxation is the biggest eroder of your wealth. It's not fees or rate of return. It is taxation, because it costs so much taxation to get 50,000 in hand. So I'll also let you know that I've set these up for children as young as 15 days old. and they have decades of runway for this thing to compound. When I tell you that grandparents and parents who have the benefit of wisdom and age to look back and say, what can I do for my child or grandchild to give them a great start so it benefits their child and grandchild? That is legacy, affecting 3 to 4 generations behind you by putting one important gift in place, by buying one of these for your grandchildren. Notice I didn't say on, for, because you're buying it for them so it can benefit their grandchildren if things go right. Huge. Decades of compounding on a gift that is predictable in that, yes, we may not know how much it's going to increase by, but we know there will be cash accessible more and more every single day this thing's enforced while this person's alive. Huge. So really, what's the value of implementing proper advice? Well, it's priceless. It is priceless because knowing how to set these up and use them in conjunction with whatever your overall plan is priceless advice to your family. What peace of mind, what a peaceful, stress-free existence, as R. Nelson Nash, the founder of this concept, would say, and what effectiveness and comfort going forward. So, I mean, who's used these? You're talking about this stuff. I've never heard of this before. Well, you might have heard of this guy, Ray Kroc, McDonald's. He's used this to help his business. Not a bad way to go. How did McDonald's turn out? Do you want to ask Ray what the rate of return on his policy was? Does it matter? Will he remember? Or does he remember that when he needed cash, he could access it to do the things that he wanted and make the investments that were key? Same with Jim Poplinski with leasing. When he needed cash, he had access. And of course, a guy who you may or may not have heard of, Walt Disney from Disney World. When he needed cash, he was able to access and use it. So all very important history figures. We don't necessarily need them to say that this is something you should look into, but it helps to know that these people have used these and used them effectively to their advantage. What was access to cash worth in the investments they used that cash for? Think about that. They didn't have to cash out what they had. They had access to cash because of what they had. So they still got to keep their policy with its growth and invest in their businesses that went on to become uber successful. So, I mean, who are the people I want to talk to? Who do I want to be introduced to? Well, as I mentioned, parents and grandparents wanting to give a lasting gift of legacy to the next few generations. We hear the talk of intergenerational wealth. They're buzzwords now, intergenerational wealth. But I tell you what, this is guaranteed to be intergenerational wealth if you set something like this up, right? If things go right and that child or grandchild lives on to become adults and become older people, this is guaranteed intergenerational wealth, financing their future, your future generations, and producing tax-free death benefits, but income accessible all along the way for whatever comes up, whether that's opportunities or because of emergencies, right? Who else? There's Canadians who want more control and say-so over their daily finances. People want to be more efficient while making sure their families, loved ones, and charities are provided for. Folks wanting higher than average savings rates without having to take on market volatility. Let's say you're a single man, a successful single lady. Maybe there's no children, there's no family. And you want to make sure that you can, safeguard your future as far as what's accessible with funds. These are some of the best ways to do that because you have guaranteed increased accessibility to cash. Market volatility is not going to reduce your cash. So if you want to have certainty of funds available, we need to talk because I can give you huge peace of mind and getting yourself set up with a predictable product that's going to have accessible streams of income, and you know that the market volatility is not going to wipe you out. Business owners wanting to protect themselves and their businesses while also keeping their corporation funds accessible with much better growth in a safer environment. How many business owners, because their business itself is risky, are sitting on cash that they don't want to put in the market because they don't want to have their business drop and their available cash drop? Well, if we use one of these policies, understand you'll still have access to the cash built up in it, okay? And you can use that to run your business and acquire assets as needed within your business. And you'll get higher than the rates if you just left it in a savings account in your business. And you've also increased the value of your business, but that's another whole nother topic. We'll talk about that another time. But it's a safe environment. While you take the risk in your business, you can keep your cash growing safely, right? And those who want to avoid paying tax on passive income, that reduces the small business deduction rate. I'm not even going to go into that. That's a whole different topic. But if you're a business owner that is feeling that effect, we need to talk. All right. And of course, wealthy families and families with some disposable cash that just want to preserve their estates and keep their disbursements private. These are private contracts between you and the insurance company. Okay. And if you as a parent or grandparent set this up and hold the ownership, understand if you've got a child that gets to adulthood that's getting a little flaky and you think they're going to take the money, put aside and just go have one big party, then you can retain ownership for as long as you need to until they show maturity and hand it over. It's not one of those they hit 18 or 21 and you've got to hand over ownership. So you have control, and if you need access to the cash, then you do so. So it gives you control while allowing you to give the gift for future uses for your children and grandchildren. So it is awesomely flexible that way. Right? It creates a cascading private generational wealth. Right? So guys, that is what I wanted to chat with you about today. I know we went through a bit. So we talked again about actual versus averaged. And for more information, please reach out. Glenn Griffiths, Griffiths Insurance and Financial Services. We help take care of your future. And in this case, we use the infinite banking concept to help make sure that your actual funds are going to be there for your uses throughout your lifetime and be more predictable for later on versus some of the averages that we get told. Because if the average hits you at the wrong time, as we showed in the example with Bart, it's not fun. Numbers mean nothing at that point when you see what you can use and what you can't. So I'm going to ask you guys to please like and subscribe. I know this is a lot of information, a little long, but for your own personalized chat or for your own personalized situation, let's have a chat. Reach out, Glenn Griffiths, Griffiths Insurance Financial Services. We're here to help. Thank you and take care.